The US dollar share of global official foreign exchange reserves declined to 56.77% in the fourth quarter of 2025, according to the International Monetary Fund. This realignment is driven by the expansion of non-traditional reserve assets and imputed unallocated residuals, which rose to 6.13% of aggregate portfolios. Consequently, central banks are shifting liquidity out of G7 sovereign debt markets to insulate balance sheets against jurisdictional asset freezing actions. This structural shift alters global capital allocation, reducing the convenience yield traditionally enjoyed by Western clearing centers. As alternative financial message rails scale, the historical coupling between international trade invoicing and safe asset demand is decoupling. You are watching Macro Frontier. Macro Frontier. According to the International Monetary Fund's currency composition of official foreign exchange reserves dataset, the US dollar's share of aggregate global portfolios contracted to 56.77% in the fourth quarter of 2025, down from 71.10% in the year 2000. This long-term trajectory was clarified by an IMF methodological overhaul engineered by researchers Glenn Quendy and Aaron Nephew, who eliminated historical unallocated residuals by applying a stratified mean imputation model retroactively across a 25-year time series. The revised data proves that the dollar's decline has not significantly boosted traditional alternatives like the euro, which holds a stable 20.25% share, or the Chinese renminbi, which actually compressed from its 2022 peak to 1.95% by late 2025. Instead, the primary transmission mechanism is an institutional rotation into non-traditional reserve assets, which expanded to command a record 14.90% of global allocated holdings. The structural consequence of this diversification is a persistent reduction in the automatic recycling of global trade surpluses into Western safe assets, permanently raising baseline borrowing costs for advanced deficit economies. Data from the revised International Monetary Fund historical series reveals that the unidentified currency residual climbed to 6.13% in the fourth quarter of 2025, more than doubling its 2021 baseline. Concurrently, traditional G7 safe haven assets experienced structural contraction, with the Japanese yen compressing below 5.3% and the pound sterling falling under 4.1% of aggregate global portfolios. This shifting allocation operates via an explicit de-risking mechanism, where emerging market central banks deliberately accumulate highly liquid domestic or regional currencies to insulate national balance sheets from external regulatory interventions. By shifting liquidity pools into non-aligned monetary assets, official institutions bypass the standard G7 correspondent banking architecture and reduce the aggregate velocity of traditional vehicle currencies during routine trade invoicing. The structural consequence is a permanent fragmentation of the global financial safety net into localized monetary nodes, which ultimately reduces global financial interdependence and weakens the transmission speed of Western monetary policy adjustments across developing economies. Statistics compiled by the World Gold Council demonstrate that global central banks maintained an unprecedented purchasing velocity between 2022 and 2025, absorbing an average of 1,000 metric tons of physical bullion annually. This institutional accumulation culminated in a major macroeconomic shift in late 2025, when aggregate official gold reserves converged with net foreign official holdings of U.S. Treasury securities. Total net sovereign buying reached 863.3 tons in 2025 despite record spot valuations surpassing $5,500 per ounce, representing a vast expansion above the historical 2010 to 2021 annual average of 473 tons. The National Bank of Poland led European institutional demand, adding 102 tons in 2025 and 45 tons in early 2026 to achieve its mandatory 30% reserve allocation target, while the People's Bank of China added 27 tons in 2025. The core transmission mechanism is the utilization of physical gold as an absolute non-jurisdictional macro hedge against global fiat credit expansion. The structural consequence is that physical gold has re-emerged as a foundational anchor of international reserves, displacing long-term debt securities. The sovereign gold rush is accompanied by a coordinated physical repatriation campaign as central banks systematically reduce reliance on foreign financial custody infrastructure. The World Gold Council's 2026 Central Bank Gold Reserve Survey reveals that the proportion of central banks storing bullion at the Bank of England fell from 64% to 57%, while those utilizing the New York Federal Reserve dropped from 17% to 14%. Mechanically, official institutions are executing this shift through direct physical withdrawal programs. For instance, the Banque de France repatriated 129 tons of gold from New York vaults between July 2025 and January 2026. Similarly, the Reserve Bank of India reduced its foreign custody share at the Bank of England and Bank for International Settlements from 55% in 2023 to 22% by March 2026. This transmission mechanism eliminates third-party jurisdictional risks during geopolitical conflicts. The structural consequence is a physical fragmentation of global liquidity, which heavily diminishes the geopolitical and regulatory leverage traditionally exercised by Western financial capitals over sovereign assets. Project mbridge reached its minimum viable product phase in mid-2026, processing an aggregate cross-border transaction volume of 470 billion renminbi, equivalent to approximately $69 billion. Operating on the purpose-developed mbridge ledger, this parallel architecture directly connects the Hong Kong Monetary Authority, the Bank of Thailand, the People's Bank of China, the Central Bank of the UAE, and the Saudi Central Bank. The underlying technical platform employs Ethereum virtual machine-compatible smart contracts to coordinate wholesale central bank digital currencies for real-time, peer-to-peer atomic settlement. This design bypasses the traditional 2 to 5 business day clearing lag and high fee structures inherent to the legacy SWIFT correspondent banking network. The transmission mechanism functions through the direct deployment of local central bank money on a single shared ledger, removing any operational requirement for intermediate dollar vehicle accounts. The structural consequence is the establishment of high-volume commercial trade corridors that operate completely insulated from Western clearing systems and standard regulatory oversight. Granular data from the mbridge platform reveals that over 95% of its total transactional volume is denominated in Chinese renminbi, reflecting the advanced development of China's domestic digital infrastructure. Although the Bank for International Settlements withdrew from its formal coordinating role in late 2024, participant central banks assumed direct autonomous control, maintaining the operational scaling of the ledger. The transmission mechanism relies on programmatic compliance protocols embedded directly within smart contracts, which automatically execute jurisdiction-specific anti-money laundering and know-your-customer verifications. This automation completely replaces the redundant manual compliance processes that slow down traditional commercial banks within the SWIFT network, facilitating instantaneous local currency clearing across borders. The structural consequence is the creation of a permanent, highly efficient transactional alternative that systematically undercuts the network effects of legacy Western financial messaging platforms and reduces the operational impact of unilateral international financial sanctions. The global financial safety net reached an aggregate capacity of approximately $4.2 trillion by the end of 2024, with bilateral currency swap agreements constituting over one-third of this buffer at $1.7 trillion. A structural analysis by the Bank for International Settlements highlights a stark hierarchy between the Federal Reserve's uncapped permanent swap lines for advanced economies and the People's Bank of China's targeted network. The PBOC has deployed swap lines across 41 countries, totaling 3.5 trillion renminbi, or roughly $480 billion. Mechanically, these lines function as alternative balance of payments safety valves, allowing highly indebted nations along the Belt and Road Initiative to access immediate liquidity without IMF conditionalities. For example, active drawings by Pakistan on its PBOC swap lines escalated from $820 million to $4.3 billion, 2025, to service external debt and preserve foreign exchange reserves. The structural consequence is that decentralized bilateral swap networks are quietly reorganizing international emergency liquidity, undercutting the policy leverage historically wielded by multilateral Western institutions. Real economic output continues to diverge, as the expanded BRICS bloc commanded a 40.2% share of global GDP in purchasing power parity terms during 2024, compared to the G7's 28.9% share. International Monetary Fund projections indicate this structural gap will widen by 2030, with the BRICS share expanding to 41.8% and the G7 contracting to 26.3%. This shifting balance of output directly transmits into global trade finance, where the Chinese renminbi's share rose to 6.0% by December 2024, establishing it as the third most used currency behind the dollar and euro. An IMF working paper co-authored by Geeta Gopinath reveals a growing negative correlation between Western currency invoicing and a nation's geopolitical distance from the United States. The underlying mechanism is a deliberate substitution effect, where non-aligned states proactively replace the dollar with local currencies to immunize commercial trade from foreign statutory interventions. The structural consequence is a bifurcated global trade finance ecosystem where invoicing selections are increasingly dictated by geopolitical alignment rather than pure capital efficiency. Despite shifting geopolitical alignments, the US dollar retains an absolute 54% share of global trade invoicing and 58% of SWIFT financial messaging volume, demonstrating severe structural limits to rapid de-dollarization. This stability is maintained by the banking trade complementarity modeled by economists Geeta Gopinath and Jeremy Stein, where a currency's role in trade invoicing directly dictates corporate debt denomination patterns. Mechanically, because international firms invoice primarily in dollars, they systematically borrow in dollars to hedge cross-border cash flows, creating a self-reinforcing liquidity loop. This loop generates massive switching costs for multinational corporations, as alternative sovereign bond markets lack the necessary depth to absorb global capital flows. The unparalleled liquidity of the U.S. Treasury market yields a persistent safe asset convenience premium, lowering borrowing costs for the United States while penalizing fragmented alternatives like the Eurozone or capital-controlled Chinese markets. The structural consequence is that while regional transactional networks are expanding rapidly for trade execution, the global financial system remains anchored to deep U.S. capital markets for long-term wealth preservation. Structural constraints are explicitly visible in the petrodollar recycling system, where Saudi Arabia's monetary architecture remains tied to Western assets. Macroeconomic analysis dismisses rumors of an expired petrodollar agreement, noting that no confirmed large-scale crude oil exports have been settled in non-dollar currencies in any meaningful volume. The transmission mechanism preventing a shift away from the dollar is the Saudi Rial's fixed exchange rate peg of 3.75 to the dollar, established in 1986. To preserve the credibility of this currency board, the Saudi central bank must maintain interest rate parity with the Federal Reserve and hold substantial liquid dollar reserves, which stood at $435 billion in 2025. Furthermore, Saudi Arabia's holdings of U.S. Treasuries rose to $143.9 billion in late 2024, cementing its national balance sheet to dollar performance. Under Robert Triffin's paradox, a global reserve issuer must run persistent current account deficits to supply global liquidity, a constraint that surplus-dependent export economies like China cannot fulfill without abandoning their domestic growth models. The structural consequence is that the absence of deep, open capital markets in alternative jurisdictions prevents any competitor from scaling into a true global reserve substitute. Quantitative data indicates the international monetary architecture is transitioning toward a permanently bifurcated framework rather than an abrupt dollar collapse. Emerging economies will increasingly route localized trade through parallel distributed ledgers like mbridge and bilateral PBOC swap networks to eliminate jurisdictional vulnerabilities. Concurrently, official central bank demand for physical gold will persist as a neutral sovereign hedge against expanding G7 debt levels. However, because alternative economic centers maintain strict capital controls and refuse to run structural current account deficits, global capital will continue relying on the deep liquidity of the U.S. Treasury market for reserve wealth preservation, establishing a highly fragmented, dual-speed financial reality. This analysis was produced by Macro Frontier. Subscribe for structural macroeconomic intelligence. The data does not care whether you are watching.